Hello, welcome back, guys. I hope you are doing well. I'm feeling a little bit better day by day, okay. But following yesterday's pretty steep crash in the markets, I wanted to make a video and talk a little bit about the US economy, the new jobs report for April, what is happening with inflation, why there is the inflation that we're seeing right now, how is Fed reacting, what we're expecting to see from them, and generally speaking, help you understand what the current economic environment is and what we're looking for in the next few months or so, in case you are not aware of these things. And these kinds of things are pretty important for investors, especially those who really want to understand what's going on in the economy, because the economy is not separated from what is happening with inflation, the customer index, all of these things. The jobs report are very, very important and play a significant role on what you'll be seeing with the market in the years to come. And so I wanted to start by taking a look at the US economy, which added 428,000 jobs in April. As you'll see, unemployment rate remained at 3.6% in a tight labor market. And on the surface, this may sound good. It may sound like a good thing, right? I mean, we are looking at an economy that is adding more and more jobs. And it seems like employees are trying to hire more and more people. It's basically an employees market. It's easier for employees to get a job than actually employers to hire. And if you have been following what has been happening lately in the employment market, it's very, very tough for employees to actually find people and sustain them, actually have them stay working for them. I was reading that the turnover rates, meaning how often people leave their jobs, are very, very high right now. And so, what does that mean? Whenever that happens, whenever employees get the upper hand that much as it is right now, employers have to do something about it. They have to fight, they have to antagonize for getting talent. And the best way to do that is by increasing wages. And so, when you are increasing wages, as you can understand, this means what? That you are providing more supply of money to the overall economy. And as you already understand, when there is more supply of money provided to the overall economy, this means that there is inflationary pressure added on top of what already exists. Now, of course, there are also good benefits from a very, very tight employment market. People working, of course, because people working more and becoming, if they are working efficiently, of course, they're producing more product. And so inflation is about the excess of money in an economy, but it doesn't act on its own. It's basically the excess of money when you compare it to what is provided as a product or service, as products or services in the economy, because that's what we use money for. It's not like we're going to be using money like dollar bills to use them as a blanket or something of that sort. We're going to buy stuff with those. And so if you think about it as a scale, in what one side of the scale you have money, and the other side of the scale you have products and services, you kind of want to be somewhere in the middle. You kind of want to be balanced. But when you have more money circulating in the economy than the products that are produced and the services that are produced, then people have an excess of that. They have an excess of money. And so, in order to buy a product, now products are more valuable than money because there is less of it. And so this is what increases the value of these products, hence increasing inflation. And as you can understand, this is what has been happening for many, I guess, a couple of years now with the pandemic. Think about it a little bit. When we started with the pandemic, what was like the first measure that was actually put in place? People had to work from home. They had to be more careful. Basically, they potentially even have had to work less. And also, because of that, and because they had to be under lockdowns, they would need some extra money. And this is what the government gave to them. And so the government, what they actually did there is they started printing money. And you remember the crash in 2020, in which the government actually started printing these checks that they basically sent to people, sort of like stopping the crash that was about to happen back then, because we were still then at a very, very bad spot with people not working. Production has fallen off a cliff. And so the US government actually decided to print some money and give it to people for free. And as you can understand, when that happens, we are increasing the supply of money, yet we are not increasing the supply of products and services. And that increases the overall inflation rate. And so we can take a little bit of a closer look at what has happened in the last few years. You will see that the annual inflation rate in the US accelerated to 8.5%. And you can understand, and you can of course see here, that it has been increasing during the pandemic years. Overall, we want inflation rate to be at about 2%. A little bit of inflation is not a bad thing, and it's generally speaking considered better than deflation. The reason for that is that when you have a little bit of inflation, money loses its value over the years, and so people don't hoard it. They tend to want to enjoy their money, they tend to want to spend their money because their money today is worth more than what is going to be worth in the next 100 years. Now, when there is low inflation, there is a very extra good thing about the economy. The thing is, when there is low inflation, let's just say 2%, this means that the cost of borrowing money is also very low. Because when you can borrow money at 2%, it's much easier for a business or a household to buy a house, or a business, for instance, to get more employees or buy more equipment, furniture. It's much easier to finance themselves through low interest rates. But when we're getting at 8.5%, 10%, 12%, 15%, it gets much harder to borrow money. And so as a business, you stagnate. What are you going to do? There is only so much that you can do for financing yourself. You can either issue shares or get some debt. But if interest rates are very high and inflation is high, of course, then how do you get your financing? The only other solution would be through issuing shares. But typically, when we are seeing high interest rates, then stock prices go down as well. Why? We're going to examine that as well because this is another very interesting point. Take a look at a company here, like a random company. For example, Peloton is an example here. You can quickly, very quickly, using our tool here, our Investors Heaven tool, you can very quickly see that the company has been negative in terms of net income. You can gauge that using the PE ratio very quickly, or just the net income growth here. You will see it's in the negative. Price to free cash flow ratio also negative. Issuing shares though, so financing themselves through shares, and also negative cash flow. So this company is a company that's not making money from operations. So you would consider this company when you wanted to invest in this one, maybe let's just say 3 years ago, and be like, why would I invest in this thing? I mean, it doesn't make money. Yet we were in a period of time where interest rates were very low, and this means that there was a lot of trendiness in the markets and a lot of good sentiment, and people were willing to spend money. And by people, not only just retail traders, but just institutes, pretty much everybody, because money was cheap, was basically free. Borrowing money was basically free. And if you have watched my previous videos, I have explained how, for example, return on equity works and how it can get massively elevated and massively leveraged using debt. Because if you think about it a little bit deeply, think about owning, let's say, $100. You can use this $100 to make, let's say, $10. But if you have $1 million, then you can use this $1 million to make much more than $10. And so if from $100 you can make $10, imagine how much you can make from $1 million. And if you can actually borrow this million at a 2% interest rate, then more power to you. You can make a ton of money practically free just by using very little debt, because inflation allows for that to happen. But when inflation rises, as we'll see here, then the actual price of things tends to rise much faster. And when this happens, the Fed has to do something about it, because if this continues happening and prices get inflated and continue going higher, then you're gonna be watching an economy that is gonna be crumbling, because things are gonna be super expensive. They're gonna be going into recession eventually. And what you want to see is a way to sparkle the economy again by lower interest rates. You want, by lower inflation, I mean. You want the economy to be able to borrow money to businesses and people so that its gears can actually move again. Yet right now we are at a high level of inflation, and as the level of inflation is high right now, what the Fed wants to do is increase the interest rates, meaning increase the cost of borrowing money, so that for you and for me, for you and me and everybody, every business, it's actually tougher to borrow money right now because it's gonna get more expensive, and it's gonna keep getting more expensive. And if that happens, if the cost of money gets more expensive to borrow, then there's gonna be less supply of it because people are gonna be finding it tougher to get more money on their hands because it's gonna be expensive. And so thus it's gonna bring inflation down. There's gonna be less supply of money pretty much through the years. It's gonna be less used, at least, because it's gonna be more expensive. And so I wanted to show you an article here, which I find that it's very, very useful and very interesting. You can also read the whole thing if you are interested. I would definitely recommend it. You can see the URL here. And this one actually talks about some policies to reduce inflation and has some examples as well. Typically, these are, for the most part, monetary policies. I mean, the Fed does something about it, for example. And listen to this one, for instance. In the UK and the US, monetary policy is the most important tool. The inflation target tends to be typically set at a rate of 2 to 3% for the most part. 2.5% is what you typically want to see. But when that doesn't happen, increased interest rates will help reduce the growth of aggregate demand in the economy. And so the slower the growth, because there's going to be, again, more expensive, it's going to be more expensive to borrow money, this will lead to lower inflation through the months. And so higher interest rates will reduce consumer spending, as you can understand, because it's going to be more attractive to save your money than actually get more money that is more expensive. And so this means that businesses are going to be taking less risks. It means that people are going to be buying less houses, for example, or less cars, or less products that they don't really need. Like, for instance, I have talked about this concept many times, discretionary products that we don't need to survive, but we need because we like cell phones, for example. So the other ways to do that, for example, supply side policies, as you'll see. So supply side policies aim to increase long-term competitiveness and productivity, because if an economy becomes more productive, that can also help fight inflation, because now we are producing more products. And so now we are actually trying to match the extra value that money has increased, has offered in the economy. And by adding more services and products, we are actually creating an equilibrium, thus bringing inflation levels and pressures lower. Of course, fiscal policies, for example, that fiscal policy can reduce government borrowing, for instance. And another thing that a government can do, of course, is taxes. Like, remember, inflation is about extra money circulating in the economy. And so what can a government do? Get that money from you. And so while they could do that, people don't really like that. And so this is something that they typically don't do to tame inflation, but it's something that could also work, as you can see in this article as well. Now, income policies, wage growth is a key factor, of course. If wages increase quickly, and we talked about previously in the jobs report, you can understand that this can also cause high inflation, because then people have more money than what gets produced, and so they are hoarding more money, and so the prices of products and services goes higher. And of course, you can also target money supplies, a monetarism which has been adopted in the UK in the early 1980s. And it's about trying to control inflation through controlling money supply. Generally considered a little bit weird to do so, but it can actually bring inflation down, but potentially cause some recession in some situations. So The other thing that I wanted to go back to was Peloton here, because we were discussing about a company that hasn't been growing, hasn't been making money, and right now, as we are entering an inflationary pressure in the economy, less and less people are actually willing to give it the benefit of the doubt. And this is what happens with all these companies that have been growing tremendously. Right now, they're going down and down and down because there is much less credit available to them, much less borrowings potentially could happen for these types of companies because it's getting more expensive to borrow, and so people are more protective with their money. Right now, they're not going to be buying anything, and this is why I have always been telling you about buying the proper companies, buying stocks and companies that are doing very, very well. They actually make tons of money, tons of free cash flow. They have limited amounts of debt, or at least very well managed debt. And you don't buy these companies that are, we don't know what they're going to be doing in the next 5 years or even tomorrow, really. And especially in this type of environment, you can very, very quickly see, if you have been following through what I've been talking about in this video, that they become a very, very, very risky proposition right now, especially in this current economy. So this is what I wanted to talk about, and hopefully help you a little bit, give you some ideas in case you are not very well aware of the current landscape. And if you ask me what do I feel about what is going to happen in the markets next, well, it's very, very tough to know for sure, of course, because this will really depend on what's going to happen in terms of politics. All this inflationary pressure has been put in the world due to politics for the most part. It happened because of the lockdowns, because of the extra money printed, and the pressures from China, of course, the extra lockdowns there as well. Supply chain pressures also causing less products to be developed, less services, and basically putting pressure to productivity. And so these things have been, for the most part, political issues that cause these effects. And so while the Fed increases interest rates and they try to tame inflation, if these kinds of things continue, and if we are aiming for more lockdowns and more issues with supply chains, then we are definitely entering a recession, that's for sure. But if we go back to what used to be the normal ways of just allowing people to work and not frighten them with stuff and all that, and we go back to normalcy pretty much, then I don't think we're going to be having a recession. Maybe some drop, some extra drop here, but probably not a recession. So it will really, really depend on what's going to happen with these very, very important matters. Pandemics, lockdowns, wars, I don't know, climate change. I don't know what's going to be the next thing in the agenda. But yeah, this is what it depends on for the most part. And while interest rates can help tame inflation, they won't do anything at all if these issues continue to remain and escalate. So thank you for watching the video. Let me know what you think. Give me your opinions about what the current state of the market is. What do you think about it? And thank you for watching this one. I hope it shed some light in case you were not very, very well aware of what is happening right now in terms of inflation and how the governments around the world try to tame it, and generally speaking, what's happening and how it can affect stocks and investing. Thanks a lot again for watching. Hopefully in the next few videos I'm gonna be having my voice back. It's almost there, but as you can hear it, not 100% there, probably not close to that either, but hopefully soon. Thanks for watching again. I hope you're gonna be having an awesome day, and I'll see you soon. Bye bye.